Hello, friends. Welcome back to Boss Economic World, the only place where we strip the suits off the bankers, decode the jargon, and tell you exactly who is winning and who is losing in the global casino we call the economy. I'm your host, and today, we are going deep. I'm talking deep underground, soundproof bunker deep, into the heart of Mumbai. Today is Monday, December 8, 2025. And if you think your Monday morning commute was stressful, spare a thought for the currency traders at the Reserve Bank of India. Because right now, they are fighting a war. The Indian Rupee has officially cracked the psychological floor of 90 against the US dollar. That's right, 9-0. It's bleeding. And the central bank is no longer just managing the situation, they have gone full Mission Impossible. We're going to talk about secret phone lines, massive US tariffs, the Trump trade 2.0, and why India is burning through $100 million a minute just to keep the lights on. Whether you're a retail investor watching your emerging market ETF melt or a Forex pro hedging your exposure, you need to understand this mechanism. Let's get into the truth. Let's start with a scene that sounds like it was ripped from a spy novel, but is actually happening right now in South Mumbai. Every morning, before the rest of us have even had our coffee, the Financial Markets Committee meets at the RBI headquarters. They look at the screens. They see the rupee getting hammered. The governor, Sanjay Malhotra, a Princeton grad who took the reins a year ago, looks at the data and gives the nod. Here is where it gets wild. This isn't an email. This isn't a Zoom call. The order goes down to a dedicated, sealed room. In this room, there are senior dealers sitting at desks with special, unrecorded phone lines. Why unrecorded? Because in the world of high-stakes currency intervention, plausible deniability is a weapon. These dealers pick up the phone and call the big state-run banks. The instructions are terrifyingly specific and totally unpredictable. Some days the order is, sell $100 million every single minute until I tell you to stop. Other days it is, sell everything until the price hits 89.95. And on the scariest days of all, the order is, do nothing. Step aside. Let it burn. Why this cloak and dagger? Why the secrecy? Because the RBI is trying to break the psychological back of the speculators. If the market knows you are going to sell at 90.00, the market will just sit there and eat your lunch. But if the market thinks you might sell at 90.00, or maybe 90.50, or maybe you'll wait until lunch, the speculators get scared. As G. Mahalingam, a former bigwig at the RBI, put it, speculators are going to come into the market with an apprehension that they're going to get hurt very badly. That is the game, folks. It's not economics, it's poker. And right now, the RBI is bluffing, raising, and going all in simultaneously. Now, you might be asking, boss, why is this happening? India is a growth engine. Why is the currency performing like a meme coin? Let's look at the data, because numbers don't lie. In 2025, the Indian Rupee has tumbled 4.9% against the dollar. Now, that might not sound like a crash to you crypto brothers, but in the world of sovereign fiat currency, that is a landslide. Among the 31 major global currencies, the rupee is currently the third worst performer. The only currencies doing worse are the Turkish lira and the Argentine peso. And let's be honest, being in a club with Turkey and Argentina when it comes to currency stability is like being in a club for people who enjoy punching themselves in the face. It's not where you want to be. Here is the kicker, this is happening in a year where the US dollar index is actually down by about 7% globally. The dollar is getting weaker against the euro, the pound, even the yen. But it is crushing the rupee. Why? 2 words, Donald Trump. Or rather, his administration's policies. We are living through the reality of a punitive 50% US tariff on Indian goods. The trade war is back, and it is ugly. A failure to nail down a trade deal with Washington has left Indian exporters bleeding out. When you slap a 50% tax on exports, fewer dollars come into India. When fewer dollars come in, the demand for the rupee drops. Add to this a widening trade deficit and massive foreign outflows, investors pulling their cash out of Mumbai and parking it in safe havens, and you have a perfect storm. The rupee at 90 is half the value it traded at in 2011. Imagine that. In 14 years, your global purchasing power has been cut in half. That is the silent tax of depreciation. Let's talk about the man in the hot seat, Governor Sanjay Malhotra. His predecessor, Shaktikanta Das, was known for a heavy hand. He clamped down so hard on volatility that in December 2023, the IMF actually reclassified India's exchange rate regime from floating to stabilized. In IMF speak, that's a polite way of saying, you guys are manipulating this thing heavily. Malhotra is different. He's playing a smarter, riskier game. Ishwar Prasad over at Cornell calls it leaning against the wind. What does that mean? It means Malhotra isn't trying to stop the hurricane. He knows he can't fight the Fed and the US trade representative forever. Instead, he is intervening at the margin. He's smoothing out the bumps. He's letting the rupee slide, but he's trying to make sure it slides gracefully rather than falling off a cliff. The IMF likes this. They recently upgraded India's classification to crawl-like. I know, crawl-like sounds like an insult, but in central banking, it's a compliment. It means the currency is moving, but in a controlled manner. But here is the problem with leaning against the wind: sometimes the wind is a tornado. Nomura Holdings estimated that in the 4 weeks leading up to November 21st, the RBI was burning through $3.5 billion a week to defend the currency. In the last few weeks, they've tapped the brakes, selling only about $1.2 billion a week. They are trying to conserve ammo. Why? Because even a war chest of $686 billion in reserves isn't infinite. This is the part where we separate the casuals from the pros. Pay attention, because this is the mechanics of the crisis. When the RBI intervenes to save the rupee, they sell dollars and buy rupees. Think about that transaction. The RBI takes dollars out of its vault and throws them into the market. The market gives the RBI rupees. Where do those rupees go? They go into the RBI's vault and out of the banking system. This creates a massive liquidity crunch. The banks suddenly have less cash to lend. This drives up short-term interest rates and chokes off economic growth. It's a vicious cycle: you save the currency, but you strangle the economy. Just last Friday, Malhotra had to announce that the RBI would buy bonds and do a Forex swap to inject $16 billion back into the system just to keep the gears turning. They are stepping on the gas and the brake at the same time. But the real danger, the ticking time bomb, is the forward book. Because the rupee is capital controlled, a lot of the trading happens offshore in London, Dubai, and Singapore via non-deliverable forwards. To fight speculative attacks there, the RBI doesn't just sell spot dollars, they sell dollars in the future. As of October, the RBI's net short dollar book was around $64 billion. This means the RBI has promised to deliver $64 billion worth of US dollars at a future date. If the rupee continues to crash, the cost of sourcing those dollars skyrockets. They are essentially shorting their own crisis. If the rupee goes to 95 or 100, that $64 billion short position becomes a financial black hole. Jamal Meklai, a veteran who has been trading currencies since before some of you were born, said it best: "I'm pretty sure the RBI has some lines drawn where they'll really come in like gangbusters." But where is that line? 92? 95? No one knows. And that's exactly how Malhotra wants it. Is there any hope? Is there a light at the end of this depreciating tunnel? Maybe. And it comes in the form of a man named Rick Switzer. Switzer is the deputy U.S. trade representative for the Trump administration, and he is flying to India this week. He is the man who can turn off the tariff pain. Malhotra is betting the house on a deal. He has been talking it up, saying he expects a good trade deal. If Switzer signs a piece of paper that lifts those 50% tariffs, the rupee could rally back to 88 or 87 in a heartbeat. The short sellers would get squeezed, and the RBI would look like geniuses. But if the talks fail? If Switzer leaves with nothing? Then the floor falls out. The market will realize the RBI is low on ammo, the trade deficit is unfixable, and the forever depreciation mindset that Meklai warned about will set in. So, what is the verdict? We are watching a high-stakes game of chicken between the Reserve Bank of India and the global financial markets. On one side, you have a central bank armed with secret rooms, $600 billion, and a strategy of chaos. On the other side, you have the relentless gravity of US tariffs and a global market that smells blood. For the people of India, this isn't just numbers on a screen. A weaker rupee means imported oil costs more. Electronics cost more. Inflation creeps in through the back door. For you investors out there, the lesson is clear: volatility is the new normal. The RBI is not going to defend a specific level like 90.00 with their dying breath. They are going to make you pay for every inch you take. They will retreat, ambush, and retreat again. The era of the stabilized rupee is dead. Welcome to the era of the guerrilla currency. Watch the wires this week. Watch for Rick Switzer's plane to land. And if you're trading the US dollar to Indian Rupee pair, keep your stop losses tight, because when those phone lines in the soundproof room light up, you don't want to be on the wrong side of the trade. I'm the boss. This is the economic world. And remember, in the market, if you don't know who the sucker is, it's probably you. See you next time.